Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with David Ingles.
Happy Friday and good morning. Our top stories today: President Trump announcing a slew of industry-specific tariffs, from patented drugs to heavy trucks, kitchen cabinets, and also bathroom vanities.
The president also advancing plans for American investors to buy TikTok's U.S. operations from ByteDance, valuing the unit at $14 billion.
As far as markets go, stocks across the Asia-Pacific down after strong U.S. economic numbers, clouding the outlook for future rate cuts. The dollar is set for one of its best weeks this year. Silver topping $45 for the first time in 14 years.
Plus, Xiaomi unveils a $630 smartphone to take on Apple's iPhone 17.
Good morning. Muted as far as risk appetite is concerned, declines across most risk assets. First, we had the strong dollar, higher yields, good economic numbers out of the U.S., and then going into the session this morning, we had this flurry of announcements coming out of the White House. We'll get into all of that in a moment. As it pertains to markets, as you can see, we are set here for some losses going into the open today. In fact, when you look at some pharma plays in the region, we'll unpack really what this means. Patented pharma products specifically, you're looking at declines across some of these names, and certainly this will be one cohort of stocks we'll be tracking going into the open in Greater China. We talked about the stronger dollar, right? Bloomberg dollar index, dollar yen. On top of the strong dollar, you had this Tokyo CPI print, which pretty much missed all but a few estimates out there. Dollar yen is now within strike, 150. We'll be talking about that at the moment. 714, 715 on dollar China. And of course, we talked about silver, gold, bottom of your screens, also coming up very, very shortly. Precious metals plays very much in focus, given, of course, this move up in silver and, of course, in gold as well. Just the approach to the open today, and, of course, within the Chinese market, certainly equities, certainly within equities, it's tech. But the bond markets have really given us something to talk about with yields at these levels. We haven't seen a 30-year yield in China going back to about December of last year. So we are on track for 3 weeks of losses as far as that's concerned. So this is really an area we'll be tracking going into the thick of things this Friday, Yvonne.
Yep, in terms of what to watch, obviously the tariff seems like that's making the headlines once again, what we've been seeing from President Trump. So is the tariff man making a comeback? That certainly is one thing we're watching this morning. In terms of sectors, we're watching the gold plays, the precious metal plays, silver, as Dave mentioned there, pharma in particular. We're already seeing that impact here in the rest of the region. We'll see how some of these China pharmaceutical biotech stocks are going to react to that news from President Trump as well. Horizon Robotics, certainly some news there, certainly one to watch. Also watch Manhua Holdings, right? This is the one when it comes to furniture, and that might actually be also feeling the effects of what Trump did when it comes to tariffs on that fund. Talk a little bit more about eFund. They're launching an ETF here today related to the AI side of things as well. We have a whole ETF sort of theme on the show, on the China Show today. Earnings, including New World Development. That's the next one to watch, of course, after getting that loan that we will talk about a little bit later on. And, of course, the CGB losses that we're seeing in the bond market.
Yeah, lots to get into as we go into today. In our top story, and this refresh, this reboot of the tariff conversation out of the White House here, announcing this new tariffs on a wide range of products, right? Pharmaceuticals, furniture, and also trucks. Let's bring in John Herskovits, our Bloomberg East Asia government editor from Tokyo, with us right now. Our China correspondent Min Min Lu also covering, of course, one side to this as well. John, let me start with you. How significant are these new announcements from Donald Trump, especially when you look at these product categories here, John?
Yeah, I know it's a wide range from trucks to kitchen cabinets. So the one with the trucks is interesting. It's 25% levy. Trump did this with the intention of trying to protect the domestic industry. And we have some really iconic names which are a part of the U.S. truck manufacturing landscape, Peterbilt, Mack. So we have that on trucks. And then we have the pharmaceutical one, which is 100% levy on patented pharmaceuticals. Now, this seems like the most punitive on paper, but there's actually a huge loophole. It's a little bit porous in that companies can avoid this levy if they have a plant under construction, breaking ground on one. It's a loophole that really allows for these companies which have these drugs to be able to skirt the 100% levy. So quite a bit going on with the announcements that Trump made today.
John, it's almost like a whole slew of it. So the markets right now, the knee-jerk reaction is to sell on the news. But who do you think, or what do you think these tariffs are targeting in terms of markets, economies, and who is the most vulnerable to this?
Sure, we're seeing the companies, the pharmaceuticals are, of course, the biggest sectoral part of this. And these are companies in India. Singapore is also worried about some of these things. And I'm not sure of their construction plans in the U.S., if they'll be able, the major makers will be able to skirt these. But we'll see some companies that are being hit in the kitchen cabinets, in upholstered furniture, another category that was mentioned by Trump today. We'll probably see some stock slides specifically for companies in Asia because of this. But the markets overall seem to be impacted more by what's going on with the Fed and overall economic data. So some specific companies may get hit, but the bigger markets, I think, are not going to be really affected by what we saw coming out of Trump today.
Right. Min Min, let me bring you in on the TikTok angle here. What's the latest here? We did get, of course, more information on where this goes from here.
Yes, President Trump signed an executive order that mapped out a plan or a way for ByteDance to divest the app, so they have to reduce their ownership to below 20%. It's still not clear now who is going to be involved in this deal, but the executive order would extend another 120 days for the deal to be closed. And from our previous reporting, we know, based on sources, that Silver Lake could be a part of that, as well as MGX, which is an Abu Dhabi-based state-owned investment firm. But Oracle is going to be a key player. They are in charge of securing U.S. data and securing the algorithm to make sure that it is free from foreign influence. So what we understand now from U.S. officials is that ByteDance, under this plan, would license a copy of the algorithm, which Oracle would then retrain from the ground up. It would inspect the algorithm to make sure that the way it feeds content to users is, compliant and is free of foreign influence. So there are still a few big questions now in terms of uncertainties, right? Whether or not Beijing will approve this, because the foreign ministry so far, its statement has been quite vague in the sense that they say that the deal has to comply with Chinese law. And the other big question is the price tag, because J.D. Vance has said it would be valued at about $14 billion, and that is still far below what some previous projections had been, which is around $35 to $40 billion.
Interesting, the Chinese haven't quite publicly said anything about this deal just yet. We also have the premier in the U.S. speaking at the UN General Assembly and speaking to a lot of the U.S. CEOs. What was the message there?
Yeah, it is a pitch to some of these friendly partners in the U.S., right, to get them to advocate for better U.S.-China relations. So his key message there was about how U.S. and China should continue to be friends, and that China will strive to improve or create a stable and healthy growth in China in order to create more opportunities for foreign companies. So again, Premier Lee was there. It is his first trip to New York as premier, and it comes as early in the week he also said that China would give up some of its privileges as a developing country under the WTO. So some of these are seen as potential concessions that China is willing to make in order to perhaps remove some of these points of contention with the U.S.
Team, thank you so much. Min Min Lo, our China correspondent there, and out of Tokyo, John Herskovitz, our East Asia government editor, on all the top stories here coming through, in fact, the last few hours or so. In fact, coming up here, more analysis really on these new tariffs coming through, with a lot of voices coming through here in the Asia-Pacific. And on the China show today, Cameron Johnson, I think, will be joining us later today. We'll see what happens with this. Going into the open today, lots of other themes at play: stronger dollar, higher yields, and of course, where do we go with the tech play as well? Alibaba is on track, in case you're curious, for its best month since it listed here in Hong Kong many years ago. This is the China Show.
All right, we talked about how it's almost like an ETF theme that we're having on the China Show here today. And JPMorgan had launched ETFs this month that really gave individual investors in Taiwan and South Korea access to U.S. tech. And there are some of the asset managers launching products to meet demand for U.S. tech stocks from Asia's retail investors.
Yeah, let's bring in Philippe El-Asmar here, APAC head of ETF Direct and Digital at JPMorgan Asset Management. It's very nice to see you, and good morning. Lots to talk about. Active ETFs. Yeah. What's going on there? It seems that you guys are busier than what is capable right now. What's going on there?
Let's set the stage maybe globally in terms of active ETFs.
Yeah.
So worldwide, there's about $17 trillion of assets under management for ETFs.
Yep.
$1.5 trillion of that, about 8%, is in active ETFs. While they represent only 8% of the total AUM, this year they've gathered almost 30% of the net flows. And roughly speaking, every 2 years they double in size. So this is kind of a big trend that is impacting the ETF industry globally.
Yeah, in Asia, we're seeing a lot of that innovation come to the region as well. Yeah. Where do you see as the more opportunities, really?
Yeah. Asia is a little bit behind the US when it comes to active ETF adoption, because our first active ETF was launched in Australia in 2015. That's for the industry, compared to the US 2008. So we're almost 7 years behind the US in terms of active ETFs. And here in our region, it's only 5% of the total. So there's $2 trillion listed locally in Asia Pacific, but only about $100 billion is in active ETFs. And it's predominantly in the two markets that launched them first, meaning Australia and Korea.
And what's the why here? Like, why are we seeing all the net inflows, and why are we seeing it doubling almost every year? To what would you attribute that?
I think active ETF is an improvement on the ETF vehicle that is used to be predominantly only passive.
Right.
So think about, for example, a comparison between an active ETF and an active mutual fund. The active ETF is more transparent. You get to see on a daily basis all of the holdings that you have. In a mutual fund, you only get to see it once a month.
Yeah.
Active ETFs is more liquid. They trade on the exchange like any other ETF. And they're also more cost efficient because they're typically priced at the institutional share class of the mutual fund. So if you have a mutual fund that has 1% for the retail share class, the institutional share class is 30 basis points. The active ETF will be priced at 30 basis points. So it's more transparent, more liquid, and more cost efficient.
Just this new ETF when it comes to U.S. tech that retail investors in Asia can really get their hands on now, right now. Tell us what the flows are like right now. Yes. Obviously, there's still so much talk about the Mag 7 and really driving all the bull markets out here.
So in Asia, as a region, we're actually having a very strong year, and we just got almost $2 trillion of assets under management as a region. So just to put things in perspective, 3 years ago, in 2023, we're just at $1 trillion. So almost doubled the ETFs listed locally. At JPMorgan, what we do is we have locally listed products. We have 10 ETFs in China. We have, we're going to be launching our first ETF in Taiwan.
Yeah. That's next month, right?
Yes, okay. October 22nd is the first listing, and we have 9 ETFs listed in Australia. But in addition to that, what we have done is we've registered some of our US ETFs in Japan and some of our European ETFs in Singapore. So every market in Asia has a different strategy for us, but we're trying to think about the market and find the best solutions for it.
Right.
Yep.
No, go ahead.
Yes, for example, here in Hong Kong, we partnered with Hong Seng, and back in July, they launched the first ever master feeder structure where the ETF was an active ETF by JPMorgan listed here. So every market in Asia has a different approach, and we try to adapt our strategy to have locally listed products or locally registered products in the region.
Now, with the pickup in active ETFs, and you mentioned this comparison with mutual funds earlier on. I mean, conceptually, it seems like that is near a zero-sum game. In other words, why would mutual funds continue to exist? But I guess in practice it might be slightly different, right? So how do you bring the cost down as far as the on the ETF side is concerned?
So first of all, I don't think that ETFs will replace mutual funds. There's a place for both in investor portfolios, and probably JPMorgan is one of the only asset managers globally that has net flows in both of our mutual fund complex as well as our ETF complex. Sometimes maybe it's misconceived that the clients that are buying mutual funds and ETF are identical. They're not necessarily the same.
Okay.
Mutual funds are sold, ETFs are bought. And in Asia Pacific, for example, beyond what is listed locally in the region, which is $2 trillion, we estimate that there's about $1 trillion from Asian money going into US ETFs or European ETFs. So that's sovereign wealth funds, pensions, insurance companies, asset managers that maybe don't typically buy mutual funds, that are buying ETFs to do their asset allocation from that perspective.
Understood.
I know a lot of your focus is on the U.S. What about China right now? I mean, obviously we're in bull markets. How much interest are you hearing from your clients?
So we actually have 10 ETFs listed in China, including one that just listed 2 days ago. So this is a big focus for us. We are one of the only global asset managers that have a local presence over there. And so we've listed 10 ETFs so far, roughly about $4 billion of assets under management. And also, the place where the products are listed, as well as the underlying, are different. So we have some China-linked ETFs listed in the US or in Europe.
Okay.
So the domicile of the ETF and what it's linked to is different.
Right. It's almost as if you're giving your clients, wherever they are in the world, the flavor of the other part of the world.
Correct.
Is that a good way to put it?
Yes.
You know what's also picked up recently? Covered calls. Higher income, higher yield strategies.
Yes.
How much inflows are you seeing there? And strategically, is that something that makes sense longer term? Yes. What do you think is behind that flow?
So I was earlier at a Bloomberg event here where I was in a panel where we were asked to predict what would be most successful this year in terms of products. Of course, it's very hard to predict that kind of specific product disclosure. But what I did mention is that the one certainty this year is going to be a lot of uncertainty. And between tariffs and what happened on Liberation Day, as well as the geopolitical situation, volatility is heightened. Now, the one product that does well in this kind of environment are these covered call strategies. Because the higher the volatility, the more income the investors can get out of these products. And that's why, if you look at active ETFs in the US, in Europe, and ETFs in the region, the most successful products in terms of net flows have been these covered call strategies, because the more volatile the market, the higher the income the investor gets.
But it doesn't quite bode well when there's bull markets, right? It caps the upside because
Correct.
it's limited to the strike price,
Yes.
right?
So the investor is giving up the upside above a certain amount, but what they're getting in return is the recurrent, consistent income. So these kind of covered call strategies that started from a ground start maybe 5 years ago now represent $170 billion worldwide as a category. And JPMorgan is a leader in this category. We have about $75 billion in covered call strategies listed in the US and Europe. And we bring those strategies either via this master feeder structure that I described for Hong Kong, or registering them, or basically selling them to institutional clients in the region.
I think the forecast of our analyst at Bloomberg Intelligence, Rebecca Sin, you might know her, of course, I think she's joining us in the shows in a couple of minutes, is that you guys will be #1 globally in active ETF. That's her prediction.
Yes.
Mission
I agree
accomplished.
with her. Yeah. We're there in terms of flows. We're actually #1 last year and this year to date in terms of flows in active ETFs. So JPMorgan has about 150 ETFs globally and 300 billion in assets under management. But what makes us different from all the other ETF issuers is that 75% of all of our ETFs are inactive. And so we are #1 in terms of flows and aspire to be the best active ETF provider in the world.
What about in China? Are active ETFs, is that likely going to get approved?
They exist, but there are restrictions in terms of Asia Pacific as a region in terms of what active ETFs you can do. The only market that is similar to the US that allows non-transparent active ETF using derivatives is Australia. But every other market in our region has some constraints. For example, Korea requires you to have a correlation to the benchmark. China has a tracking error budget, so you cannot deviate too much from the index. In the US, you can deviate as much as you want. So they exist, but they're still new in China.
And you get a sense that is from an investor protection standpoint, that you can't sway too much from beta and the index itself. Why do you think that exists? And do you see the changing, in fact, this regulatory friction?
I think it's a matter of time. As I mentioned, our region is a little bit behind the US. So the first active ETF was launched in the US in 2008. In our region, it was 2015 in Australia. But only at the end of last year, for example, did Taiwan approve active ETFs. So I think it's just a matter of time before every market kind of approves active ETFs. And that's why actually we're entering the Taiwan ETF market, because they can now launch active ETFs in Taiwan, and it's a very interesting
What's
market.
happening there? Can you tell us? I mean, obviously ETFs are big in Taiwan, but what do you think is really driving that?
Sure. So 7 years ago, Taiwan was the second smallest market in all of Asia Pacific when it came to ETFs in general. They only had $20 billion of assets under management. Today, Taiwan has $230 billion, almost tenfold in 7 years, and it surpassed Australia, Korea, and Hong Kong to become now the third largest market after China, Japan, Taiwan. So that's why it's a very interesting market, and it's a good mix between individual investors. There's 15 million individual accounts buying these ETFs, but also institutional clients. About half of the investors in the Taiwan locally listed ETFs are institutional clients.
Philippe, nice to see you.
Great.
Have a great weekend ahead. Yeah, it's been rough weather-wise, but all things equal, I think we're doing okay. Hi to the team as well. Philippe El-Asmar, their APAC head of ETF Direct and Digital at JPMorgan Asset Management. Yep, as Yvonne is pointing out, it's a bit of a theme today. And it's Friday, I think, is the spin there. ETFs. In more than a few minutes, of course, Sylvia Zhang will be joining us out of eFunds there to discuss also a pair of new ones. One on AI, the other one to the point we were just making on dividend plays. And yeah, we're counting down to the open of trade, just over 8 minutes away. We're looking at pharma stocks coming up on your screen very shortly. Yeah, the new tariffs in place today, 2% to the downside in your pre-markets. Hang Seng Index going into the open today, looking like this. This is the China Show. Good morning. Right, welcome back. A lot of themes to track here. So one is really this pullback we're seeing in CGBs. This is the index itself, our index that tracks that lowest since April as far as this is concerned. We're down 3 days going into today. 30-year futures is just another way of looking at this. More specifically, this one actually at the lowest level going back to March of this year. So we are on track for 3 weeks of this backing up in long-dated Chinese bond yields. There's a 3-year bond auction today, just to mention that as well. But yeah, certainly something that we're tracking amidst this sort of seesaw between CGBs, the bond markets, and of course the equity market that's done exceptionally well of late.
Yeah, so it continues to see that sort of rotation back into this equity market, perhaps. So we'll see how this fares. But today, you are seeing a lot of headwinds in terms of what we saw when it comes to the Fed discussion, given the data that we got overnight, plus stronger dollar, plus tariffs. So it might be a bit of a triple whammy here in terms of what to navigate through to wrap up this trading week. There you go. Hang Seng is lower by 0.8%. Pharma seems to be the focus here, as Trump did announce 100% tariffs when it comes to branded or patented pharmaceutical products starting from October 1st. That's why you're seeing the likes of Beijing down some 3.5% or more. Furniture was also the target here this time. So we're talking about some of these when it comes to Hong Kong listed furniture sort of companies too as well. I think Manhua was one of the ones that we found as well. Here's what they're looking like here right now.
Yawning it off, actually.
Yeah, not doing too much. And then Horizon Robotics, right? So there's a placement there. They are offering shares $9.79 to $10.29 each here. So they're raising about $843 million there. Share placement down, they're down about 5% for that stock. Crypto firms. So we saw certainly a slump in crypto, which we've been talking about as well. Maybe because due to some of the dollar strength, maybe due to the risk-off moves that we're seeing. But we definitely saw it in Ether overnight, Bitcoin as well. We are seeing some of these crypto-related stocks to the downside today.
Yeah, we took out 110,000 there. As you can see on Bitcoin, we're a little bit higher in the Friday session of the Asia Pacific, but certainly it has been one asset class, along with many other risk assets correlated to each other, that have been taking a backseat as the broader undercurrent is really this move back into the dollar. You have stronger data out of the U.S. You have some Fed cuts, well, a fraction of the Fed cuts that were priced this time last week are being priced out. So you have the dollar coming through, set for one of its best weeks so far in 2025. So there is that, of course, to contend with, plus the broader conversations around all this uncertainty around tariffs yet again. Well, that's Friday for us. The Open is next. This is the China Show. Welcome back. You're watching the China Show. It's a bit of a personal rant on my end. So I went for a haircut actually early this week. I think they did a little bit too much. I now look like an anxious dog. But anyway, I think we can try and
now you have the show.
Sort this up a little bit so it's uneven. And yeah, I mean, we'll work this out. Maybe.
Yeah.
We don't want to be distracting on air. There's lots of news to talk about.
Yeah, you're definitely distracting everyone right now.
Yeah.
Okay, let's these markets as we wrap up the trade week. I mean, it's been a long week, right?
It has been a long week.
We went through a super typhoon. Markets were certainly it was very interesting given what the Alibaba news and the dollar is making a comeback. Tariffs are making a comeback as well.
Who would have thought that?
And it really has kind of upended this kind of rally that we've seen in most markets, and China included here, given what we're seeing. So CGBs, we talked about that just a bit here, but we are still talking about downside when it comes to onshore equity markets here today. We're down about 31%, the CSI 300. I think on week we're still expected to see some pretty decent gains, though, for the week.
Yep.
But there you go. 30-year yield, though, we're coming off a little bit. We're down some 2 basis points, but as Dave mentioned, that 30-year yield has been the highest we've seen
this year.
Of this year already. So, but today we are seeing a little bit of that rotation back into bonds here, maybe given the risk-off moves we're seeing in equity markets. We continue to watch what goes on with CATL. That continues to be an up arrow story here after that upgrade from JPMorgan yesterday. This whole ESS demand seems to have made CATL more like an AI play than just, EVs, Dave, of late.
Because, they're moving into that part of the supply chain.
Yeah. So really, it's interesting. You take a look at when it comes to Hong Kong. Certainly, we're focused very much on whether it's what we're seeing in the pharma side of things, furniture, stocks. And there you go. It looks like it's a pretty ugly day here in Hang Seng. We're down about 1%. HS Tech is on offer. And you're seeing Alibaba. There you go. After what has been a pretty good week for them, we are seeing some profit taking potentially in the tech space here. So Alibaba is down 1%. Same goes to Meituan. Xiaomi is also lower, but there's a lot of anticipation about this phone. It's also the 17 that they're launching.
Is it the 17?
It's also the 17. They wanted to match it.
They didn't have a 16, though.
I know. They skipped a model just to match it with the iPhone launch.
See what they did there.
So there's a bit of a comparison. The CEO took 2 hours in that presentation, by the way, comparing that product with Apple's. There you go. So there you go. We're seeing Tencent slightly to the downside here today, but it's really, you're seeing downside when it comes to Alibaba, Baidu. These are the AI darlings as well. Meituan, Xiaomi also this morning. China pharma stocks, that's the one to watch. Given what you've been seeing in the pharma space, there's a lot of uncertainty what this means, right? Because 100% pharma tariffs, yes, sounds pretty scary on the headline, but there are caveats to it, right? So companies that are building their pharmaceutical manufacturing plants in America will be exempted. That's according to Trump in that Truth Social post, without including any more details. So right now, the knee-jerk reaction is to just sell on some of these stocks here. We're down about 5% for Beijing. Pharma, Maran Beijing also down as well. So that's one to watch. And then we have to talk about everything from crypto. I mean, everything's basically seeing some risk off here.
Yeah, we talked about this crypto, Bitcoin taking out 110,000. So that's one group of stocks we're tracking today. On top of that, maybe on the upside is things like precious metals, for example, with gold. We talked about gold a lot already. Silver topping $45 for the first time since 2011. In fact, I just had a look at my chart. We're about 7.5% from setting a fresh record there for silver. I guess we can get to that in a moment, but this tariff conversation is really taking us back here. So it takes effect on October the 1st, and it doesn't help, I guess. We'll talk about this graphic in a moment. It doesn't help that, biopharma has been one of the best performing sectors here in Hong Kong. So there's that temptation to take money off the table, even if these names aren't directly involved in this conversation. Okay, let's talk about ETFs now, right? So you have, and let's take the story back to China, right? Because the fact that the market has really found a solid floor on one part has been because of all the flows coming in from the national team to support the market. Obviously, there's the AI theme that's taking us a little bit higher as well. $180 billion of assets as of the end of August. Bloomberg Intelligence says a unit of China's sovereign wealth fund, we talked about the Central Huijin, has reaped more than $50 million in paper gains because of their presence in this part of the market. Let's bring in Rebecca Sin, our senior ETF analyst, to help us understand what is going on right now. Give us an update of the overall market, and we can talk about these other themes.
So the Central Huijin, which is also called the National Team, is the sovereign wealth fund of China. They have been purchasing ETFs at a record speed. So since 2023, they've purchased close to $180 billion worth of ETFs. We did an analysis of when they purchased to market now. At the end of August, it accounted for roughly at least $50 billion in profit. So a record number for ETFs. And what they've ultimately done, and this is the first time ever, they said that they're going to use ETFs to prop up the market. So what we've seen is when the CSI 300 drops below 3,300, they would come in and buy ETFs. And so they're replicating what Bank of Japan did with using ETFs to support and prop up the market. And so it's been very interesting to follow this trend because they've never done this before, but they're also buying at a much quicker speed. So Bank of Japan started purchasing ETFs in 2010, and only last week did they say they're going to start unwinding their position. And so now if we look at China, they've only just started buying the past 2 years. But what this has mean for the ETF market is that overall it's made ETF approval much quicker in China now. And so they're approving ETFs at a much faster speed now. There's a lot more fixed income being approved. They've created a repo market that they're testing where you could use your ETF as collateral and then take that cash and invest it into something else. They're also in the process of approving foreign market makers to allow the foreign market makers like Jane Street, Flow Traders, Jump, Optiver to come in and be official market makers on Chinese names. So overall, it's been beneficial for the ecosystem, and it's definitely boosts the sentiment in China.
What about the ETF market in Hong Kong? And what's sort of the correlation to China, this cross-border investment?
So if we look at flows in mainland China, more than 50% of the flows this year have gone into Hong Kong ETFs. And so this is an amazing number. So like, for instance, Hang Seng Tech up almost 40% this year. A lot of investors in China are looking to diversify their portfolio and coming to Hong Kong. So ultimately, this is very good for Hong Kong. The Hong Kong ETF market is up close to 70 billion in assets under management. And just today, eFund is launching 2 new ETFs on the market. They have the AI Tech and a high dividend ETF. In Hong Kong, high dividend ETFs have done phenomenally well. As Philippe mentioned earlier this year, Hang Seng has a high dividend ETF. It got the most daily inflows this year ever at 83 days. So if you think of that, that's a record number. We were hoping that they would break 100, but they only just launched in April. So in Hong Kong, we're seeing a lot of people interested in ETFs, and the main interest is ultimately dividend. People are looking for income. And in Hong Kong, we have one of the highest income products in the region. So for instance...
How much dividend yield do I get?
The maximum is 16%.
Let's get to it. Right?
Paid on a monthly basis.
16%.
So this is a phenomenal amount.
That's annual. I've got later, that's annual. But yeah, 16%.
16%. And so in Asia Pacific, investors are really in search of income and yield.
Right.
And between Hong Kong and Taiwan, we've seen a lot of double-digit returns. In the U.S., you don't get this. So for instance, if we look at active ETF, JPMorgan's premium equity ETF, JEPI, which they've partnered up with Hang Seng, that gives on average 8 to 10% income on an annual basis.
What's the 16% one?
The 16% one is a mirror ETF.
Okay.
The Hang Seng one is, I think, is at 12%. So it's still phenomenal. And in Taiwan, we see the same thing. In Taiwan, you have double-digit returns, mainly because of TSMC and how well it has done.
Fantastic. Okay, lots to munch on there. Rebecca, thank you so much. Rebecca Sin, our Bloomberg Intelligence Senior ETF Analyst. Staying on theme here, China's largest asset management company, eFund, is listing 2 ETFs in Hong Kong today. One is on this broader popular theme that's picked up of late, AI. You might have heard about it. The other is on the one we just talked about there with Rebecca, income and high dividends. Sylvia Zhang is a global index strategist at eFund Management and joins us right now. Good morning and very nice to see you.
Good to be here. Yeah.
So tell us about these 2 strategies. Why now and why these 2 specifically?
Yeah, I think for the global AI one, we think that it currently is kind of the right time to invest in the global AI. I think to invest in global AI, there are two things we really consider. The first one, it's really important to take a full industry chain approach. Basically, we have to invest in not only computing power, but also the models and also the applications. It's not only like a piece of area or a piece of sector, right? And second one is that it's a global trend. It's not only like we should invest in only one country or one region. And we think that there are 2 prerequisites for the AI development. The first one, is computing power and data. The second one is a top tier like talent. So in these 2 areas, both China and the United States, I think obviously hold a significant lead. So that's why we created this global AI ETF, mainly focused in China and United States. So I think that's for the AI.
Yeah, I mean, that certainly has intensified, right? Can you take a look at the 2, China and U.S. competing when it comes to the whole AI race here, ecosystems. How do you think is the best way to capitalize on these investment opportunities?
I think, this AI trend, I think there should be 3 stages, especially comes from the valuation side. The first stage actually, begins in this, I think the beginning of this year, triggered by the DeepSeek. I think, this kind of gives us a valuation recovery to about multiples of about 20. And currently, I think we are in the kind of the second stage, where we see that the impact of AI commercialization actually become visible in all the financial reports. And we do believe that looking ahead, the third stage, which lies ahead, is like along with the further, the AI applications, especially the AI agents and cloud services, will unlock the huge potential for the next stage valuation expansion.
So this AI ETF one, it's interesting that you pointed out because this is actually a bet on both.
Yeah.
It's bet both. So you don't have to pick one. And certainly there is, people talk about this as a zero-sum game. So how much does it cost? What's the cost ratio for this? And effectively, how do you guys come up with the constituency that goes into it? What does it track, basically?
Basically, it's tracking the FTSE Global AI Selector Index and mainly focusing in China and US. And just as I mentioned, that it's taking a full industry approach, selecting from computing power to models and to AI applications.
Sure.
And total TER is about 90 basis points.
Okay.
Yeah.
90 basis points.
Okay, let's talk about the dividend one. That's gaining a lot of traction in Hong Kong. Why do you think that's happening, and what's behind this momentum?
I think just as Rebecca mentioned, that, in terms of the investment objective, people are not only solely focused on the higher capital gains. There's a strong demand for also the stable cash distribution, especially when we look globally. There's I think an increase in demand for all the cash dividend paying ETFs, especially in the United States and also in Europe. And second one is that, if we look at the global dividend stocks, it's very interesting because, in terms of shareholder returns, basically the United States or the British, they favor share buybacks over dividend. However, when we look at the APAC developed markets, it's quite different. Companies tend to, offer more dividends over the share buybacks. So that's why we chose this, Asia Pacific developed markets to create a multiple region high dividends yield strategy. Yeah.
Okay. Now, what are your expectations as far as AUM? Do you have any initial projections of how much you think will go in and how much you think will eventually come into your strategies here?
Yeah, we do think that if we look at because these two ETFs are eligible for the ETF Connect. If you look at the fund,
okay, that's good to know. Okay.
Yeah. So if you look at the fund flows, we know that in terms of the sector, all the sector ETFs, two categories really stand out. The first one is robotics. The second one is AI ETFs. So we do think that there should be a significant amount of inflow from China mainland. And what's interesting is that we know that this year, actually, the institutional investors, especially insurance investors, they increased a lot their positions into the sector-related ETFs, especially the tech-related. I think that's the first one. The second one was really interesting is that the dividend ETFs also attracted a lot of net inflows within the smart beta category. And what's also very interesting is that we have seen that actually institutional investors are kind of trimming their positions. However, the retail investors are adding their positions to this dividend strategy. So
why do you think that dynamic exists?
I do believe that it's kind of because a lot of institutional investors may kind of take in profits or rotate to other sectors. However, the interest rate of deposit is quite low in China. So basically, retail investors are seeking to some higher yields. Because of this AH premium thing, the dividend yield of Hong Kong stock market is really good. So I think that's maybe part of the reason.
We just had a conversation with Rebecca, you just heard there, and of course one of your peers out of JPMorgan. And one of the concerns that might be where the industry is actually headed is just too many products.
Too many products. From. Yeah.
What do you think of that specific risk? That there's too many that people are getting confused already in terms of what to choose.
You mean too many ETFs to choose?
Too many ETF products in the market right now.
Yeah, I do really understand. I think one of the characteristics of Chinese investors is that they prefer higher elasticity. Sometimes, especially in the bull market.
Okay.
So basically, if we look at data, or maybe give you some example, our robotics ETFs, it really offers the high elasticity whenever the robotics ETFs goes up.
Okay.
So basically, I think if we look at the investment behavior behind all different types of ETFs, some ETFs really give you some niche exposure to a certain thing.
Sylvia, it's great to have you. Thank you so much. Sylvia Zhang there, Global Index Strategist at eFund Management. And if you are a subscriber and want to rewatch that interview, you can also join us on our interactive TV function, TV Go. You can rewatch some of the big interviews of the day and become part of the conversation. You can send us instant messages or even questions for our guests throughout the shows. Check it out at TV Go. We're keeping an eye out on New World stock this morning. That's after the Hong Kong builder secured a $508 million loan. That actually does, though, fall short of the high end of its initial target. Let's bring in Bloomberg's China credit reporter Trisha Luo on more on this loan. I mean, 75% less than the upper end of that target and that was seeking earlier. So what does it tell us about New World now?
Yeah, so at least they managed to secure the around 4 billion Hong Kong dollar loan, right? And it's backed by Victoria Dockside, is crown jewel assets in the city. But initially, the builder actually aims to raise 15.6 billion Hong Kong dollar backed by that collateral. So it's actually falling short, but I think investors expected they can raise something, but not achieve that amount. So it's not, I won't say it's a huge surprise or disappointment to the market, because everyone know some existing lenders already say they're reluctant to add their exposure to these snakes. But I will say, like, all in all, it's good to have this, but definitely they need more money right now.
Yeah, and we'll get a better glimpse of the financial health of the company because they're releasing earnings today. What are we looking out for specifically on in this earnings report?
Yeah, I think people are keen to see their latest financial numbers, including incomes, asset sales, gearing, etc. And then I think investors are also keen to see, what they are going to use this fresh money to do, right? Will they tender bonds? What would they use this money for? So I think there's some key questions people are looking at, and whether New World would talk about their, forward-looking plans to deal with its dollar bonds, and also whether they would talk about the capital injection plans we reported earlier. So there are still lots of questions around this name, and investors are definitely keep a close eye on this.
Yeah, and no doubt you'll help us find out.
Yes.
Right, all right. Trista Luo, there, our China credit reporter on. Want to watch, of course, New World reports later today. Right, for our clients and viewers, you can get an insider's guide of the money and people shaking up Hong Kong to finance Hub, our Hong Kong edition newsletter, out every Thursday. One yesterday, of course, was focused in on the weather.
All about storm watching, storm forecasting, the thankless job of being the observatory given these extreme weather conditions. Really unsung heroes in some ways as well. You can check it out and sign up through the website, Bloomberg.com/newsletters. Here's some corporate stories that we're tracking for you today. Alphabet's Google is asking the U.S. Supreme Court to pause a ruling that would force it to overhaul Play Store policies. Google warned in a filing that without a delay, the company and its Android ecosystem will suffer irreparable harm. The move stems from its long-running antitrust fight with Fortnite maker Epic Games. And Bloomberg has learned that Citigroup moved nearly 1,000 tech jobs to India's business support centers following cuts to its workforce in China. Sources say the Wall Street lender shifted the jobs in phases over the past few months. Now, back in June, Citigroup announced plans to cut its technology workforce in China by about 3,500 as part of its global simplification efforts. Xiaomi has unveiled a new smartphone designed to take on Apple's iPhone 17. The new device, called Xiaomi 17, will be offered in Pro and Pro Max models, just like Apple's marquee series. Now, it will cost around $630 to $840. That's more than $100 cheaper than the base iPhone 17. The move signals Xiaomi going after Apple in the most direct fashion, shifting the company's branding and timing to measure its products against the U.S. firm. Even the names are pretty similar, right? Pro Max?
Well, I thought, we were...
Even the looks, right?
Even the look. We were prepping the segment earlier on.
Yeah.
And does the new iPhone have 4 cameras at the...
I don't know.
Okay. Yeah, sorry. Okay, we're...
But, yeah.
Making public our ignorance. Because that one had 4. And I'm like, since when do you need... Well, since when do you need 3 cameras?
It looks very similar.
Yeah.
Enough for the CEO to spend a lot of time during that launch, comparing the two.
And the number 16 is having a bad week. Why did you have to skip the 16? We'll talk more about this later on, of course. Okay, let's stay on theme here. It's Apple. We talked about iPhones there. Of course, Apple has long led the Silicon Valley in terms of tech, but in the world of AI, it's actually falling behind, and continued missteps could actually threaten the iPhone's dominance here. Bloomberg Originals looks at what went wrong and if Apple can catch up. Here's a preview.
Siri, what's the name of the guy I had a meeting with a couple of months ago at Cafe Grinnell?
You met Zach Wingate at Cafe Grinnell.
sad.
Actor Bella Ramsey was bailed out by a new version of Apple's Siri that was meant to be available for all.
That feature still has not been released. It's originally supposed to come out April, May of 2025, but now it's on track for spring 2026.
Apple took down the ad and is facing a lawsuit over the delay. But the disconnect exposed a deeper issue. The company was losing ground in the AI race.
They totally missed the boat. There was indecision. There was lack of concern that this could become a real thing.
This is a story about how hard it can be to stay on top.
AI is something that wasn't in their DNA.
Continued failure doesn't just hurt Siri. It could threaten the iPhone's dominance. The product line accounts for more than half of Apple's revenue. So missteps with what's become its most noticeable missing features could be devastating.
We saw this for many decades. Nokia was at the very top of the phone industry. Apple came out with a much better mousetrap. BlackBerry was at the top of the industry. Apple came out with a better mousetrap. They are going to be in danger of the next Apple being created if they don't get their act together soon with some serious acquisitions, changes, and partnerships.
Oh. I thought my computer was starting up. Isn't that like the sort of... I'm getting flashbacks of uni here. Okay, Jansi Copper and a lot of these miners in focus today. Copper's obviously seen a massive pickup this week. On top of that, you want exposure to both. Zijin, of course, has both copper exposure and also to the gold space and precious metals. And, of course, we're looking ahead to the IPO, of course, next week. Asia defense stocks in focus amidst this real pivot and 180 as pertains to, well, Ukraine for one. So we'll talk more about this in a moment. It's playing out mildly across these markets, and I'm being extremely generous with that.
All right, welcome back to the China Show. Happy Friday. We made it, guys. And it looks like Hong Kong is back to normal, really, after what was that super typhoon. So there you go. Hopefully we can enjoy the weekend. But I hear there's another storm coming.
Well, there's another one, yeah. In fact, right now it's in fact, I think, hitting the Philippines. I don't think, looking at, if I remember correctly, I don't think it's headed for Hong Kong.
Yeah.
But it's only a matter of time. It's only, late September. So we're probably going to get a few more this year. But we weathered this one quite...
Yeah.
Better than most.
Yeah.
We're blessed here if you really think about how prepared we are.
Markets are not quite weathering it well when it comes to what we're seeing when it comes to stocks, right? So obviously we've had Trump tariffs that's spooking the pharma sort of industry here this morning, given the threat of 100% tariffs. That's certainly one thing why we're seeing this retreat among risk assets here today. Also, there were some big signals from some of the Fed officials as well, some data that we got from the U.S. overnight. So certainly there's a lot to kind of sink your teeth into. But that dollar resurgence, that certainly is becoming a more emerging theme right now, Dave.
Yeah, and that's the pain trade, right? Because a lot of people were expecting the dollar to continue to weaken, and certainly that's not going to happen in a straight line. And you do see really the pain points of this showing up. When the dollar starts to strengthen like this, you get the likes of, some of the sectors that have been benefiting very well, like tech, for example. I'm looking at the TAIEX index now is down 2%. We'll talk about this in a moment. TAIEX is down 2%. We're looking at Bitcoin. We talked about that earlier on, took out 110,000. So, yeah, this dollar story has really come back in a relatively bigger way than expected going into the weekend here.
Yeah, so we'll certainly talk about that. What does this mean, right, for risk assets? You've been talking about really that CPI print that we got out of Japan.
Yes, out of Tokyo today.
Pretty weak picture here. Does it actually lead to the BOJ and refrains them from hike this year? That certainly is one key question, but BI says no, not quite.
Yeah, our folks at Bloomberg Economics think that soft CPI print will not derail the plans to hike interest rates. It certainly derailed some of the positioning in the markets, looking at how the reaction was in dollar yen. So you already had a stronger U.S. dollar, and then you had the weak CPI print coming through. I think it missed all but 3 forecasts on Tokyo CPI, which I guess is we'll get into this a bit further on. But the point we were just making as well, right? The stronger dollar is really hitting a lot of these tech plays extremely hard today. You have the Kospi's down 2%, and the TAIEX index is down 2%. And of course, Alibaba as the big story, we're down about 1% as a cohort there in the Hang Seng tech index. But yeah, pharma. Let's
get
the
back
big
to
one.
pharma.
Yeah, let's get back
that
to pharma.
certainly is the big focus here right now after what we heard from President Trump, right? Planning 100% duties on branded or patented pharmaceuticals starting October 1st. Now, that's unless a firm is building a manufacturing plant in America. Let's get to our Asia pharma reporter, Amber Tong, joining us on what we know so far. There's still a lot of questions, but what do we know so far?
So we know overnight that Trump announced on Truth Social that he is going, the U.S. is going to impose 100% tariff on branded and patented pharmaceuticals. And this is something that he has telegraphed for months, that he kept saying that pharma tariffs are coming very, very soon. And now we're seeing, we have a number on it. But basically, and we have the caveat, a very important caveat as well. Drug companies can be exempted from this tariff if they have started building, if they've started construction or broken ground on a manufacturing site in the U.S. And that is something that we've seen major pharmaceutical companies pledging over the past few months. By one count, they have collectively pledged $350 billion in U.S. investments over the past few months. So it remains unclear which pharmaceutical companies will be exposed and which ones may be exempted because of these investments in the U.S.
I think it takes effect on October 1st, and the caveat that if you're building already in the U.S., you're exempted from it. It's kind of too late to start building if you don't have any plans, right? Because that's next week. So I guess people are trying to figure out who really is affected by this. Are you hearing anything so far from your contacts in the industry, or is everyone still trying to figure this one out?
So we know that this is going to be felt across the whole industry because the U.S. is the largest pharmaceutical market in the world. Okay. So everyone wants to sell in the U.S. Everyone makes money in the U.S. But here in Asia, I think so far the reactions I've been hearing from analysts are a bit muted. And that's mostly because, well, let's take China, for example. Only very few Chinese companies actually have drugs approved for sale in the U.S. And those who do, either they have U.S. manufacturing facility or they're partnering with a company that does. And then, for example, if we look at Japan or Australia, a lot of them have similar arrangements. There may be select drugs that are exclusively manufactured in Asia and then shipped to the U.S. But it's a very complicated supply chain, and it might be hard to pinpoint which drug comes from where. And so I think a lot of people expect the impact will mostly be felt by European drug makers or companies with large manufacturing presence in Europe, because that's actually where a lot of the complex biologics, complex therapies that make the most money are manufactured. And in fact, Trump himself I think that the White House has singled out Ireland as one place where a lot of pharmaceutical products are manufactured, and they want to take that back from Ireland.
Okay. Amber, thank you. Amber Tong there, our Asia pharma reporter. And pharma isn't the only sector in Trump's crosshairs, right? Earlier, he also announced industry-specific tariffs targeting heavy trucks, as well as when it comes to furniture. Let's bring in Cameron Johnson, a senior partner at TidalWave Solutions, and joins us now from D.C. Obviously, we've seen tariffs come back on the headlines here. How are you interpreting some of these latest lines that we're seeing from the Trump administration?
So this is just the continuation of a very long process that will continue to go on probably for the rest of the administration. And I think some of what we need to look at is, as Amber just stated, there are some signals previously of what they want to try to reshore or what they will tariff. But at the same time, they are going to try to go after instances of what they see as flooding the market, which is what the Truth Social tweet was about, particularly in regards to furniture and cabinets. So this is just kind of the continuation of the process of tariffs that we'll see for probably the rest of the administration.
All right. So, I mean, this derail the progress we've seen, broadly speaking, on, we just learned about the TikTok conversation and the progress there, and we're now looking ahead to potentially, of course, that meeting between the two. Does one affect the other, Cameron, in your view?
Not for China. It will definitely affect some negotiations, particularly, for example, with additional negotiations with Japan and South Korea. For example, Samsung Biologics, that does monoclonal antibodies, they don't have a facility in the U.S., but they do have R&D in San Francisco. And so it's really unclear what exactly is a manufacturing facility. None of this is actually clarified. And to your point, this is one of the biggest issues we have, is we don't know what it actually means, what these statements mean. Is a manufacturing plant mean you have to manufacture for everything in the U.S.? Does it mean you can just have a lab set up and you can produce? It's really unclear. At the end of the day, though, 90% of all prescriptions written in the U.S. are generally for generic drugs. And this particular order doesn't seem to hit APIs, the active ingredients in drugs. So for the short term, it may not have as big a hit as we think, but as these becomes more clear, it could have a much bigger impact down the road.
Can you tell us, I know it's still a lot of unanswered questions, but in terms of who is most exposed or what countries are most exposed, are we able to kind of, find some winners and losers in all this right now?
So it's a bit of a mixed bag. For example, anybody who does not have a manufacturing plant in the U.S. is exposed. But for example, Novartis is investing $23 billion to build or expand 10 U.S. plants. But again, part of the challenge with understanding what the current tariff situation is that only for specific products, or does that mean if you're producing any product in your portfolio, you are now exempt from tariffs as long as something is produced in the United States? All of this is unclear. Another one that I'm watching is kind of the Takeda Pharmaceuticals, which is in Japan, because they export a lot of drugs that are used in different oncology practices and rare diseases. They do have some manufacturing in the U.S., but again, it's a smaller footprint. But it is unclear exactly how this is going to be hit overall and which countries will take the brunt.
So Cameron, what do we need to know? Like what clarity would you be looking for right now for it to be, I guess, from a motivation standpoint, for this to be actionable on the part of, well, the targets, right? Pharma companies.
Yeah, the first is the 100% tariffs actually means what? Does it mean 100% on top of the current tariffs? For example, if you're a European firm and Europe is at 15%, does this mean now all of these products are now 110 or 115%? That's number one. Number two is, what exactly is the definition of a manufacturing plant? What's the volume? What is the actual APIs that have to be imported to do that? And third really is who's buying it? For example, if the U.S. government is buying these drugs, is there an exemption? Because obviously you don't want the government to have increased cost. So those are some of the things that we need to understand moving forward.
A lot of Chinese companies have been relying, I guess you could say, Cameron, on these kind of out-licensing deals to kind of expand overseas. Do you think that model is definitely in question now?
Not at the moment. And part of it is because we just don't have the clarity. But if you're licensing, obviously you're not exporting yourself into the United States. And so at the moment, they should be shielded from that. Now, the U.S. could come out and say, listen, we need to have drugs that aren't tied to a Chinese pharmaceutical supply chain or even R&D because of national security. But at the moment, they haven't done that. So if you're just licensing and somebody else is producing it, that's not your problem. You're still going to get that revenue, and you're still going to be able to continue to license those products across the board.
Real quickly, Cameron, you got furniture, cabinets, trucks that are now tariffed now. How should we be looking at this and the impact we could see in this part of the world?
So for trucks, it's a lower impact, primarily out of Japan. But for Vietnam, Thailand, China, cabinets and furniture are absolutely going to be a killer. And again, at the moment, for example, Vietnam's at a 20% rate. If they add for the upholstery as well as the furniture, that could additionally be a total of a 50 to 70% rate. That basically means you're on par with China, and your sales are no longer as competitive as they were. So this could really affect supply chains moving forward, particularly since there aren't that many places that can make those kind of products in Asia. It's basically China, Cambodia to some degree, Vietnam, and a little bit in Thailand.
Yeah, and affecting renovation plans and budgets, right? We can talk about that next time. Cameron, thank you so much for staying up as well. Cameron Johnson, they're out of the United States for us, our senior partner at TidalWave Solutions. Okay, we just talked about the weather here and this typhoon, of course, that is currently affecting the Philippines. You have the central bank now talking about how it will be suspending essential banking services from 1 p.m. local because of the typhoon taking place. More on that in a moment once we have more understanding really of what essential banking services actually means. Is that physically closing the branches? More on that, of course, as we try and understand more. Plenty more ahead. This is Bloomberg. Right. Welcome back. Happy Friday morning to all of you. You're watching the China Show. It's been nearly a year since HSBC announced its major overhaul to its businesses under, of course, the CEO. And certainly one of the big changes that's really taken place has been the creation of this new international wealth and premier banking arm.
Yeah, joining us exclusively now is the head of one of its segments under it, HSBC Group Insurance CEO Edward Moncreiffe. Now, they've been pushing into legacy planning. And get this, just issued a life coverage of over $400 million to a Singaporean family.
Oh, you got me.
This month.
I'm not Singaporean, but yeah.
Here to tell us more is Edward. Edward, it's great to have you here in the studios. Tell us a little bit more about these jumbo policies. Why do you think they work when it comes to some of your high net worth clients?
Yeah, thank you for having me. As you mentioned, we issued over $400 million of coverage to meet the wealth transfer needs of a family in Singapore earlier this quarter. That's on the back of issuing similarly another $400 million of coverage to a family in Hong Kong. So it's part of a wider trend that we're seeing where first-generation wealth creators across Asia are now looking to leave a legacy. And we're seeing the rise really of international wealth and the roles that Hong Kong and Singapore and their insurance markets are playing in capturing that internationalization of estate planning. So this is, I think, the tip of the iceberg, and we'll see more to come.
And that's down to, I think you're mentioning just during the break, the fact that Asia is getting older. We're also getting richer as well. How are you dealing with the risk management part of that? Because these are fairly extreme obligations, if it came to it.
Yeah, it's a great question. I mean, there's a few things there. I mean, firstly, these are long-term contracts that we're writing, where we're creating financial commitments over decades and over generations. Right? This is around intergenerational wealth transfer. That allows us as a long-term investor to apply multi-asset allocation capabilities and our institutional asset management capabilities to ensure that we can preserve this risk. And again, one of the reasons I believe we're succeeding or we're attracting this wealth is because we're part of a large banking group that frankly has been a custodian of wealth in Asia for over a century. You know, we've got a fortress balance sheet, we've got very strong credit ratings, you know, and that allows customers to feel confident that they can leave money with us for prolonged periods of time, and that we will safely wrap, preserve, and transfer that to the next generation.
What's the client profile like now when you look at Hong Kong and Singapore? Is it still rich Chinese? In Singapore?
I'd say it's varied. Right? Yeah. I mean, the one thing that all of our high net worth clients have in common is that they are typically first generation wealth creators. Right? And they've accumulated significant wealth, but that wealth is largely tied up in the business or in property. It's in illiquid, indivisible assets. So what our insurance solutions allow us to do is to provide the certainty, the liquidity, the flexibility, you know, on a very low-risk basis to transfer that to the next generation so that wealth can be allocated accordingly. If you look at Singapore and Hong Kong, for us, they're very complementary. I mean, they're serving, you know, largely but not exclusively different international corridors. Hong Kong predominantly into Greater China and Northern Asia. Singapore as the gateway into ASEAN and increasingly into the Middle East. So they are very complementary, and the products and the solutions we're offering in these two markets are very different.
Apart from the two markets, what other key priorities do you have, geographically speaking, under your watch?
Yeah, so we've said very clearly that we want to be a leading international wealth manager with a particular focus on Asia and the Middle East. And as I said, we are, for the insurance franchise, HSBC Life, we are a market leader in Hong Kong. We are growing very fast in Singapore. And then what these two international financial capitals allow us to do is to attract international wealth. And these offshore to onshore corridors
into the hubs, okay,
are getting stronger and stronger, deeper and deeper. You know, the advisory capacity in these markets is going up, client sophistication is going up, and I think that's a big tailwind for large, deep, sophisticated balance sheets and writers like ourselves.
I want to get into the investment side of things of the business. Obviously, the Feds began cutting rates again. You also have the weakening of the dollar as something. How do you see that impacting the overall business?
For our insurance business, actually very little. And the reason why is we're a very long-term investor. Our average liability, our average contract is over 20 years. So that does allow us to take a very long-term view. We've been fortunate to be a recipient of significant premium inflows these past few years, whilst rates have been pretty high. Yeah. That has allowed us to pre-fund significant bond purchases and lock in yields, which are very attractive and can ensure our liability pricing is consistent. But we've also been allocating into alternative assets for a number of years now. So we have quite sophisticated diversification of different vintages of private equity, of private credit, increasingly infrastructure debt as well. You know, and again, as a long-term investor with illiquid liabilities, we benefit from that illiquidity premium and that complexity premium.
Do you see needing to do more of that?
Yeah.
This move more into alternatives in private markets?
I wouldn't say do more. I mean, the business is growing. If you looked at our first half results, I mean, we grew our annualized premium to $3.8 billion in the first half. Okay, that's plus 30% versus prior year. So the premium inflows are coming up, and we're comfortable with our strategic asset allocations and the mix that we have. But we will certainly be deploying more capital because the business is growing very, very fast.
Yeah, you mentioned some of the places that appeal to you in the private asset side of things. What are places that you would stay away from in the private market?
Not so much that we'd stay away from. Again, we're looking at diversified multi-asset portfolios because we're meeting long-term guarantees and trying to generate alpha for our policyholders across the market. So it's less about which assets. It's also largely to do with the regulatory capital charges that these assets attract. And that can occasionally move. And also we have big differences occasionally between Hong Kong and Singapore around how these assets are treated.
Right. Are there assets that are a no-go? So the reason I bring that up is certainly you look for yield, and I wonder an asset like gold, for example, that doesn't actually yield you anything, but has done extremely well. And we've seen structural flows into the asset class, and I wonder as an insurer, is that something that even tempts you?
It is definitely something that tempts us because our customers are demanding it and inquiring it. So actually in Hong Kong, we recently launched an indexed universal life policy, which is again designed for high net worth legacy and legacy planning, where customers can self-select into a gold index, right? And that's been proven to be quite attractive. It's the first time that an insurance company's introduced this, and I think we'll see more of that going forward.
Understood.
In terms of, there's a lot of questions about whether, treasuries are still that sort of safe, haven sort of asset anymore. I mean, how are you looking at it from HSBC's perspective?
Again, from a life insurer perspective, we are providing capital guarantees, and occasionally in some of our products, we are providing long-term, income guarantees as well. And on that basis, most of our customers over the long term do choose to have US dollar denominated products. It's the world's reserve currency, and you purchase insurance because it is deemed to be a lower risk, more preservation wealth vehicle. So on that basis, we typically will back US dollar liabilities with US dollar assets. And on that basis, we would, as you'd expect, be a large investor and allocator into US treasuries.
Your outlook for the core business itself, you mentioned, of course, the growth in premiums as well. Do you have any visibility of where you think you want to be this time next year?
Sure. We disclosed again at the half year that our new business CSM, which is the deferred profits that we generate from new business, was up to $2 billion. So that's more than 50% up versus prior year. So it shows we're coming in with pretty decent tailwinds and capturing our fair share of the demand. As a group, we've committed to sustain double-digit revenue growth across our wealth franchise. And insurance has got to be a core contributor to that.
That's right.
I think HSBC almost went viral yesterday with that story about
the quantum computer.
The quantum computing.
Did you see that?
I did see it,
and really effectively determining bond pricing. I mean, in terms of AI, how is it helping your business right now?
Yeah. Great question, and the question that is asked by staff pretty much every day. I mean, what I would say is, as an insurance business, we've been using AI for decades, right? I mean, our actuarial pricing, our liability pricing, is all based on big data. Where we've started to make, I think, some tangible progress in the last couple of years is around Gen AI, and it is around the large language models. We're starting to use that for co-pilot tools for our frontline agents and bankers across the region. They can have more informed conversations with clients. And we've also started to use it in our claims and underwriting capabilities. So our health business, for example, we're able to now pay health claims in 5 minutes because we've linked our AI tools to our claims engines and to our payments engines in the banks, which means we can make determinations very quickly and we can move money around the system very quickly.
Edward, it's great to have you. Edward Moncreiffe there, HSBC Group Insurance CEO, joining us here exclusively in our Hong Kong studios. We've got plenty more ahead. This is Bloomberg.
Right, welcome back. A lot of little subplots we're tracking across these markets. So copper plays across the Asia Pacific are seeing some money being taken off the table. Certainly, it's been a decent. We've seen a decent few sessions this week on the back of the move up in copper prices. Now, all that being said, of course, when you look at some of the names like Jiangxi Copper, for example, which we talked about a few minutes back, not feeling the pain right now as far as this is concerned. We're looking at Ceres Group, listed, of course, in mainland China. I think this is an approval at the CSRC.
Yes, so another listing in Hong Kong to look into, right? Yeah. So jumping 10% to a record high for the stock on the A-share market here after they did get approval from the CSRC to list here in Hong Kong. So this is also Huawei's EV partner, planning to issue and list as many as about 300 million or so shares in Hong Kong, according to the company there. So one to look forward to in terms of the listings here in Hong Kong was, again, crypto certainly in focus here, given what we saw in the slump in crypto overnight. And there you go. You're seeing some of these stocks continuing on that decline here this morning. Plenty more ahead. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break here right now. And yeah, we're seeing the Nikkei just slightly to the downside here. Topics is doing a little bit better here. Most of the region is falling on the back of maybe what we've been seeing when it comes to tariffs. And certainly that's making headlines here right now. Dollar yen also as well. We're hovering around this 149 level. So still on the weaker side of things given the strength of the dollar of late here. But yeah, that CPI print that we got out of Japan certainly did leave to a lot of questions about whether the BOJ can still hike later on this year. Yeah, it was really on the, not just the softer side, it missed all but a few forecasts out there. So in fact, when you look at what we're seeing as far as the bond yields, and certainly we are looking at pricing coming all the way down, as maybe some of that gets priced out, we'll see. Core CPI coming in at 2.5%. This is similar, of course, to when you look at the other measures that were released this morning. It might also be the fact that positioning was not prepared for a print of this softness. Dollar yen, as Yvonne is pointing out, right? Who would be thinking, well, who would have thought we'd be at 150? Yeah. We're closing in on that psychological level today. Should we book our trip now, soon? I have already, in fact. I have already. That is actually my trigger for pulling the trigger. Yeah. For pulling the trigger. Tokyo CPI print is really when not the BOJ decision. That's too late, really. The market's already priced in the move. Bloomberg Economics, here we go. So the note out of Taro this morning was, let me just paraphrase here. So the Tokyo CPI print will not affect the tightening path as far as the BOJ is concerned. Of course, you have a real rates conversation taking place there, but of course it might, lead to some near-term adjustments as far as markets go. Price pressures remain sticky under the current pervasive environment. And yeah, so that's the latest line coming through out of Taro Kimura in reaction to the CPI print out of Japan. Okay, from one bond market to another. Yeah, let's talk about CGBs, right? Yeah. When you're talking about, when it comes to, I guess, melt up in yields that we've seen, right? So you talk about these bond futures, the 30 years basically now the lowest since March. So they have erased a little bit of a drop this morning, but certainly the key question is, this rotation into equity certainly seems to be sparking the sell-off among CGBs. You also have the lack of policy support, some say, as well. So that's why we continue to see the Chinese bonds under pressure this year. When we talk about the 30-year yield, it's basically now at the highest levels we've seen this year. Yep. Let's bring in Stephen Chu, of course, who can help us understand right now what this means and where we go from here as far as CGB yields. There's a 3-year bond auction today. Inflows into this market, PBOC policy. Let's start with yields. Do you see this continuing to the upside?
I think the recovery to the upside, especially for 10-year, will continue. Okay. My favorite measure is a 10-year yield, and I think at least we have to go beyond 2% until CGB become attractive again. Because investors, they always compare the US and the China 10-year, and our calculation, the model shows that anything below 2% is not attractive. Okay. Which is why we're seeing outflows, like the latest data in August shows is the 3rd consecutive month that we are seeing outflows in CGBs. Unless market come back and sell the dollar like in April and May, otherwise it's very hard to get CGB inflows to return. There's a lot of speculation about the PBOC is going to resume buying bonds again. Are you seeing any signs of that, or is that could be happening anytime soon? I think not at the moment, because yields is still pretty too low, if you ask me, so they have no rush to go and buy bonds. But obviously, if the yield curve flattens again, then they may want to do something about it. But now, especially this quarter, the bear steepening is exactly what the PBOC want to see, because they want an upward sloping yield curve with 10-year yield higher than the current level.
Yeah, I want to ask you about HIBOR in a moment, but let me just get your thoughts on, we're moving into a very long holiday next week. And I wonder, is there a temptation right now to take some of the bullish bets on the yuan, for example, off the table, now that it does seem that there's more yield on the dollar side of the conversation?
I mean, it does make sense, not just the yuan, but if you look across Asia, look across G10, there's this trade, stronger dollar trade, for example, the yen. It's kind of like market is sort of stabilizing and focused back on the Fed and yield differential. So now I think even for the yuan, even though the fundamental for China is improving, I think it makes sense to step back a little bit on the yuan.
Okay, HIBOR, I think we're above
4%?
Do we get to 4%, do you think?
I think we actually about peaked. The very last...
We peaked, okay.
Yeah, I think we have peaked. Well, of course, there's this last knee-jerk action that could bring to 4%, but I think the key indicator for HIBOR peak is a 1-month and 3-month inversion, and we are inverted right now. So it's a matter of time. In the very near term, we should see the peak.
Okay. Stephen, thank you. Stephen Chu there, joining us from Bloomberg Intelligence, talking all things HIBOR, FX, rates, and the like. Here are some corporate stories that we're following for you today as well. Meta is reportedly in early talks to use Google's Gemini AI models to improve ad targeting. According to tech publication The Information, the move highlights Meta's struggles with its own AI and growing pressure to deliver better ad performance. Meta has spent billions on AI researchers and projects, but several stumbles have plagued its efforts. Alphabet's Google is asking the U.S. Supreme Court to pause a ruling that would force it to overhaul Play Store policies. Google warned in a filing that without a delay, the company and its Android ecosystem will suffer irreparable harm. The move stems from its long-running antitrust fight with Fortnite maker Epic Games. Bloomberg has learned that Citigroup moved nearly 1,000 tech jobs to India's business support centers following cuts to its workforce in China. Sources say the Wall Street lender shifted the jobs in phases over the past few months. Back in June, Citi announced plans to cut its technology workforce in China by about 3,500 as part of its global simplification efforts.
All right, let's shift to robo-taxis. And Baidu says it is exploring new markets for expansion. That's as its fleet hits operational profitability targets in several cities across mainland China. Let's bring in Annabelle Jewellers, of course, a tech correspondent here with us on set, who had an exclusive interview with the person actually leading the overseas business, Apollo's overseas business.
Yeah, that's right. So Apollo Go is the robo-taxi arm of Baidu. It is the biggest one, actually, in China. So it was a significant interview for us, essentially, to be able to hear more from the company, because they actually don't talk about it that much, really, in the earnings. So it's kind of difficult to glean the progress that it's making. But it was important also to hear about where they're looking to go to next. Already they're in Europe, they're in the Middle East, but they're also looking and talking with governments in Australia, which was interesting, of course, because people talk about the infrastructure not being really even ready for EVs right now, but Southeast Asia as well. So I sat down with Halton. He's the person who's leading the overseas business for Apollo Go, but take a listen.
I think both Waymo and Baidu Apollo, we are the only two companies who provide over 1,000 cars in all the cities.
What does your expansion plan and your scale up look like?
We have already signed several legally binding contracts with different partners globally. Any single one of them is regarding thousands level of robotaxis deployment. I believe once we remove the safety driver from the car, the numbers of deployment can raise gigantically, right? Since what we are aiming for is the real autonomous driving, is without safety driver.
With working with US companies, Uber and Lyft, do you see any risk of geopolitics coming into the equation as well?
From Baidu's perspective, we think both China and the US have enough ability and wisdom to overcome such kind of geopolitical problems or difficulties. So we believe, since we are also companies working for new technology, also for profit, for generating profits for both companies. So I think everything will be good in the end.
When do you expect to be profitable as a business unit?
It is highly related to the government approval of how fast we can be. From the technology part and operation part, we are quite confident that we can bring the such kind of autonomous cars to any single city wherever the policy is ready, the infrastructure is good, and there are real demands there. But regarding the profitability, I think, yeah, it will take time.
So each vehicle can be profitable today? Each single unit can be profitable?
Just in several cities in mainland China.
Mm-hmm. Then what holds back the profitability in other markets?
Well, if you want to generate, positive profits from one single city, I mean, on average for every single car, you have to deploy a real number of cars there. If you just deploy like 100 cars, it can never become profitable. So you have to provide some, real service to the local citizens there. You have to make your technology a part of people's lives. So demo shows cannot generate profits forever.
Yeah, so I think that profitability part was actually one of the most interesting, because this is really something that relies on scale. And so he was making the point that actually in cities where they can operate at a larger scale, and we already see that in mainland China, where they're operating, say, for instance, more than 1,000 vehicles in a place like Wuhan, for instance, they can be profitable there. But when you're moving into new international markets and you've, say, only got 100 vehicles in Abu Dhabi or Dubai, they're still losing money at this point. And that was the point he's making around regulation. You need to work with governments. They need to feel comfortable to allow you to remove the human safety drivers, to scale up your vehicles as well. And that's when true profitability comes. But it's still quite a ways to go, even as you see some pretty intense competition here, because you've got the likes of Baidu, Ponier, WeRide. They're the ones that are really expanding across Europe, the Middle East, Southeast Asia. Waymo in the US is largely staying at home. Yes, like a trial there in the UK, over in Japan, but pretty much it's a US story for now. And of course, because the US has higher taxi fares, faster regulation in some respects, and maybe more openness to this sort of technology as well.
Very interesting. All right, great interview, Annabelle. Thank you. Our Bloomberg Tech reporter and BTech Asia co-anchor Annabelle Jewelers.
Yeah, and in fact, we'll continue the conversation around tech with VC firm Raise Capital joining us in a couple of minutes here, where they are seeing opportunities. We talked about AI, this red-hot tech market, and of course the conversation around visas and the talent war when it comes to AI. Everything with Edith Yeung coming through in a couple of minutes. This is the China Show. I think this should be an understatement. I think Alibaba's done well in the last month. 27%, this alone, right? And you look at other names, similar gains. You have Baidu, you have SenseTime, really what have you. This AI theme, this re-rating, this mindset shift, and of course Alibaba has just really been the most popular one of late, has really brought the attention back here to this Chinese equity market.
Yeah, let's bring in Edith Yeung, general partner at early stage Silicon Valley venture capital fund Raise Capital. She's here in Hong Kong. Edith, it's great to have you in town.
Yeah.
I think we had you back then during the DeepSeek moment.
Yes.
And you were quite surprised by sort of the rise of AI in China. How are you looking at now, being based in the U.S., and it seems like, Alibaba is making a comeback, and everybody is talking about AI spending in China now. How are you viewing it this time around?
I think AI is the magic word for all corporate and Wall Street. And for Alibaba, it actually makes sense. They triple digit for Quinn, and the growth for cloud, I think, is 26%. And it's almost anybody, doesn't matter for NVIDIA, anybody work with NVIDIA, automatically as at least 10 to maybe even 30% jumped in stock price. And coming from Silicon Valley, there's a lot of things going on, right? So one of our portfolio company, Databricks, just raised at $100 billion in valuation, trailing about $4 billion in revenue. And just their AI product alone, in terms of revenue, is $1 billion.
Wow.
So it's definitely the name of the game for anything related to AI is a hot thing for Wall Street.
Right. Do you get a sense that fundraising in your area is underplaying or overplaying, or do you get a sense it's easy to raise money now because AI seems to be everything that people will be talking about?
I think it's relatively easy for the big startups,
okay,
like the OpenAI.
Like you just mentioned, okay, yeah.
And I think earlier this week you covered on the NVIDIA and the OpenAI investment.
Yes.
And I read a really great article this morning on Bloomberg that basically talked about how it's almost like a parent co-signed your mortgage for your first house.
Guaranteed it.
And NVIDIA has a lot of money to spend, 70 billion of a free cash flow. And OpenAI has a lot of money to spend also, 300 billion like with Oracle, another 500 billion in Stargate. And in this sense, NVIDIA basically guarantee a customer for the next generation Rubin platform. So I think for fundraising, if you are a big startup like Databricks or OpenAI, is sure, a lot of funding is go to that.
Yeah.
But for smaller tech, it's not as easy.
Yeah, I was going to say, I mean, the parent analogy, right? Parent helping your kid
start
off. I mean, is there a concern really of really for NVIDIA investing in companies and then purchasing its chips? That seems to be the concern from the market on that deal.
A little bit, of course, some eyebrows were raised for sure, but it makes sense for NVIDIA. If you look at it, $100 billion investment could secure up to 20% of OpenAI, and that is only 2.5% of their $4 trillion market cap. And guess what? $100 billion really is just 18 months of their free cash flow. And if, and only if, OpenAI become the next trillion-dollar company, this could be the next Alibaba, Yahoo investment all over again. So it makes sense for them.
People are trying to look at the entire ecosystem, and they're trying to understand it beyond hardware, designers, what have you. When it comes to startups and like the really, really early stage companies, what's hot now? Like what do you think what is meriting your attention recently?
I think at Raise Capital, we're continue to excited about AI infrastructure, and we're very proud.
That's also quite a wide.
Databricks, of course. And it's really, really wide, of course. But this year, 2025 really is the year of agentic AI. And we are seeing a lot of really interesting AI application that built on top of different LLMs. Regardless is for finance, healthcare, legal, or for specific role, not for our job yet, but the paralegal or the AI nurse, or there's either very vertically driven or specific role driven. And I'm also seeing a lot of rise of any AI infrastructure in the peripheral things like nuclear. Or quantum computing. These are things that, just buying an NVIDIA chipset alone, you still need to spend a lot of OpEx to make sure that these things are running properly.
Where in the AI space is still, you think, maybe too extreme, where we're seeing maybe a bit of, it's getting too crowded, too much spending, and maybe it's just overhyped right now?
Frothy valuations, if that is a case.
I think we certainly, as an early stage investor, we have to adjust our expectation in terms of valuation. I think valuation for early stage startup has been rising up for sure. We are seeing basically average early stage valuation is anywhere minimum at least 20 to 30 million to start, and a lot of times second or third time founder. A seed stage is already 100 million. So it is certainly expensive. But having said that, a few years ago, we don't see trillion-dollar companies. And IPO market is also making a comeback. So we're excited to see that finally some of our companies, can exit and have some sort of IPO at the end of the tunnel.
I want to ask you about the Visa story. It's really been making waves following the White House's announcement around making it effectively very expensive for companies to sponsor talent from abroad. How is that resonating in the VC industry, particularly in your specific area where there's really a lot of foreign talent that's needed?
Yeah, and I think $100,000 H-1B fee with 2 days notice is a huge mistake. And the Trump administration is basically telling the world, hey, tech founders, don't build in America if you're not rich. And it's not going to help the big tech. Small tech, really, they can't afford it. So somebody like myself, I was sponsored H-1B visa, and thanks to Oracle and Larry Ellison as my old employer, it was a very, very painful and long journey. And it's definitely not for a small tech to be able to afford and pay $100,000. And I think this is the moment when a lot of other tech hubs like London or Toronto or Vancouver that's closer to North America, or Singapore or Bangalore, which there's so many talent, and maybe even Hong Kong can take advantage of it.
Yep. Me too. I was also an H-1B holder back then. Certainly, we've seen a lot of...
wow, okay.
Yeah, I mean, not even in the tech industry. I was in journalism, and that actually was also quite an interesting sort of... Journey, yeah, for me as well.
Yes, very, very painful.
Edith, thank you. Edith here and there, general partner at Race Capital. Of course, you're a subscriber. You want to rewatch that interview. You can catch us through our interactive TV function, TV Go. You can also become part of the conversation. Send us instant messages, questions to our guests as well. Check it out at TV Go. This is Bloomberg. All right, it's all about me, not me. Me 17. This is what's launching, right? And really debuting $630. That's the answer to the iPhone 17. So it's a few $100 or so bucks cheaper, right? And from the looks of it, does it look pretty similar, Dave, to you? I mean, there's certainly how they pitched it, how they've named it is very similar. And it really coincides with the timing of that iPhone 17 launch just a few days ago.
Yeah, and I think this is really a watershed moment. I know people overuse that phrase, but the fact that we've been talking about Apple's challenges to really break the mold against domestic players in China, right? So it's not, even before Xiaomi was a household name, right? Apple had really problems with, if you go back a few years, with Samsung in China. And of course, the domestic names came up, and then now you have this specific model, and it's being marketed, if I'm not mistaken, as directly, to your point, a competitor to the iPhone 17. I mean, they skipped the number even.
They even pushed forward the release date to coincide with Apple as well. So yes, they are going head-to-head with Apple. But it seems like people are saying when it comes to the overall specs, strong specs, nice design according to Citigroup, big battery, very competitive to gain share in the 4,000 to 6,000 yuan segment, likely here as well. So certainly they're talking about the upcoming smartphone shipment data likely to support. They're talking about double-digit growth when it comes to that new phone.
I'm looking at the reaction here from our folks at Bloomberg Intelligence too, right? So in terms of the major upgrades to the iPhone 17 base model specifically, they haven't received popular consumer demand. It would actually squeeze sales of Xiaomi. Now, that said, the folks actually are now saying that we believe, I'm paraphrasing from their perspective here, that the revenue of Xiaomi could actually climb 35% this year, driven by just the overall EV and, of course, the Internet of Things business, too.
Yeah, and on Weibo, it's been trending, right? Everyone's talking about, why can't Xiaomi just be himself for once? Why don't we call it Xiaomi 18? Yeah. Just because it'll surpass Apple. It's a lot of questions about why they're pitting themselves directly against Apple as well. Is that really a good move there?
It better be a good product.
The marketing side of things.
Yeah, on the spec side of things. $630 US, which is about $100 cheaper.
$100 cheaper.
Okay. No, that's a good. I wouldn't spend any more than $500 on a phone anyway. So this is clearly I'm not the target market for this. I have an iPhone 4 still here. Anyway,
he's exaggerating.
Yeah, iPhone 5. Okay, a couple of things to track. Asia Pacific, 0.5% to the downside, and of course we're looking at. I think we have some inflation numbers coming out of the U.S. later today. That's it from us. We will see you all on Monday. Goodbye.